You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I kind of feel like we're in a really sweet spot right now. My client, everyone's happy, everyone's accounts are doing well. There's nothing close to euphoria. I'm still getting people taking profits, waiting for the pullback. I even had a client move, almost entirely to cash today because they're worried about a move to the downside. We're not having these times where everyone wants in on everything. To me, it's a really nice sentiment. Is at a really nice juncture right now. I feel quite happy with where everything is.
This is Mining Stock Education, and I'm your host, Bill Powers. Thank you for tuning in yet again. The goal of mine as the host of this show is to bring you a variety of perspectives from different perspectives or viewpoints within the resource sector, and to provide these viewpoints to you so that you can make better investing decisions from wherever your vantage point is. And so today I bring you the perspective of a full-service broker and investment advisor. I'll be speaking today with returning guest Sam Broom. He's an investment executive with Sprott Global. Now, Sam was originally formally trained as a geologist. He's from New Zealand. Done a lot of work in Australia working as a geologist, but he also understands very well the finance side of the business, and he's also pretty good at decoding charts and looking at stock charts and so forth. And if you follow him on Twitter, you'll see that Sam often will post a chart and a comment or commentary there on Twitter. So Sam, welcome back onto the show. I appreciate you joining me and taking time out of your day today. Could you begin by giving us an update, especially for myself and all the North American listeners that are listening to us right now? Give us an update on the Australian mining sector and what would be some key things that we should know.
Hi, Bill. Yeah, thanks for having me on the show again. Always good to be here. The Aussie space has been quite interesting lately. In terms of, we'll touch on the precious metals first because that's the one that's the market everyone cares about most at the moment, it seems. In the large cap space, so we're talking sort of mid to large cap producers. The Aussie markets, I wouldn't say it's cooled off, but it hasn't quite been as buoyant as the North American market. So we're actually seeing quite a lot of really enticing opportunities in the large, mid to large cap producer space in the Aussie right now. Probably say 80% of the names I've been buying, both personally and for clients in the last sort of 4 to 6 weeks have been the Aussie producers that we really like. We think that's definitely a segment of the market that has the best value right now. However, if you go down scale a little bit into the speculative stocks, the sort of exploration stocks through to development stage asset, single asset developers, the Aussie market is absolutely white hot right now. I came to this business. The sector on the investment side, 2012-ish, just in time for a pretty brutal bear market. And I haven't really experienced broad scale moves up in some of these exploration stocks or discovery stocks that I've seen over the last couple of months on the ASX. It's not uncommon for a reasonable discovery, but definitely a discovery or a drill hole that piques our attention. All of a sudden, the stock's gone from 15 million, 20 million market cap to 150 million market cap in the space of a week. Previously, we'd seen that on really stellar, standout, kind of once in a year type hits. But certainly in the last wee while, we're seeing that on discoveries which have a lot of potential, but still, there's a lot of unanswered questions, and the market's kind of in buy first, ask questions later sort of stage at the moment. So, and this isn't just one or two companies. I've seen this on at least half a dozen, and there's probably 10 to 15 names I could rattle off that have significantly multi-bagged on decent, but again, still very early stage discoveries in Australia. And it's not even just the discovery plays, but we're starting to see the better development stage plays really start to take off, or either a couple of companies that are just recently producers from developers. A couple of our favorite stocks have gone up well over 100% in the last couple of months. and are now trading at all-time highs. So, there's definitely a white hot market in the Australian junior space right now, which is quite interesting to watch.
How have the Australian miners been affected by COVID?
Frankly, one of the major reasons I like the Australian producers right now is because, especially the domiciled, the producers with the operations in Australia have been some of the least affected by COVID anywhere in the world. Having lived in Perth, Western Australia for many years, I can tell you that it really is one of the most isolated cities in the world. There is nothing outside of Perth for thousands and thousands of miles. And so far, there has been very little that I'm aware of anyway, impact from COVID on Western Australia and in particular mining operations. So that is a huge part of why I think, not a huge part, but it's a cherry on the top of why I like the better Australian miners, particularly the Western Australian gold producers right now. In case we do get that second wave of COVID that everyone is worried about, you really are going to be best sheltered in those Western Australian gold producers if you are going to own, a miner through this time.
How have the Australian traded stock exchange gold producers fared against their Canadian and North American counterparts the last 6 months on a relative basis?
On a relative basis, again, if we're talking about the producers rather than the small end, they've actually underperformed over the last 6 months, having been the major outperformers for the prior 5 years, since about 2014 until about mid-2019. They were killing it. It's a little bit hard to directly compare. The index I use the most is the Australian All Ordinaries Gold Index, the AXGD. It's a market cap weighted index, and a single name, Newcrest, which is the third largest gold miner in the world. They're about 40% of the index, and they've had a really tough time lately. They've been having some issues, and the market's punished them because of that. So if you strip out Newcrest, a lot of the other guys have done much better and are probably not comparable. Again, at the small end of town, the speculative end of town, the ASX has been crazy. It's definitely the most buoyant speculative market I've experienced in my career so far. So it all depends on where you're looking. Again, it's my favorite part of the market, that sort of high quality growth mid-cap producer space. That has lagged, and I think that is probably likely to change soon, because we did see an almost profit-taking rotation out of the Aussie names and into the North Americans as gold really started to pop. I think we're going to start seeing capital flow back the other way relatively soon, to the beneficiary of these Aussie mid caps in particular, because there really are some fantastic companies on that ASX.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion, with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com. Sam, I'd like to get your take on a recent short report from about 2 weeks ago. NOVAGOLD Resources with their 40 million gold ounce project up there in Alaska. Stock was trading upwards of $12 a share, and then this short report came out and the stock fell significantly, about 30%, down to about $8 per share. Do you have any thoughts about this specific short report, the company's response, or what should the investors listening to us know about short reports and how they make money and how it affects potential stocks like this?
Yeah, I've got to be a little bit careful here on how I answer this one, because there's a very wide range of opinions on the company within Sprott. I certainly have my own opinion on the company. Some people love it. Some people, think it's egregiously overvalued. So with that out of the way, I think, in my opinion, all you got to do is go and have a look at the reserve statement for both Barrick and NOVAGOLD, and it tells you it tells you quite a lot. NOVAGOLD have, I think, 33 million ounces of proven and probable reserves slated on their statement. Barrick has 0. So, in my opinion, what does that tell you? It tells you that Barrick doesn't think those 33 million ounces are anywhere near economic at current gold prices. So that's kind of loosely where I fall on this. It's obviously there's a lot of gold in the ground, but it's not just gold in the ground that goes into making a mine or a profitable mine. There's no doubt about it. It's a humongous gold endowment. It's going to be, if it ever does become a mine, there are a lot of things that have to go right first, and there's a lot of water under the bridge to go. So, it depends who you're asking about, what they want. If you're a gold to $10,000, and you've got the patience for a 10-15 year potential build, i.e. longer than a typical precious metal cycle, and you want that extreme optionality play of just pure ounces in the ground, even knowing that they're not economic anywhere near current gold prices, then NOVAGOLD's obviously got one of the biggest resources or reserves, depending on how you want to classify it, in the world. Looking around, I just see so much other opportunity outside of optionality plays like that personally my investing style is not, I just don't go for the NOVAGOLD type of place. So
if you were given a binary choice, would you choose one of these optionality plays, these Seabridge Gold, NOVAGOLD, Chesapeake Gold, or would you almost prefer just call options on GLD or something like this if you had to choose?
Yeah, I mean, I think you can go for optionality that isn't that far out of the money. You know what I mean? You can buy producers today that, are barely profitable at current prices, but will make a bucket load of money at $2,000 gold and play that delta without, having to, take on all that extreme sort of stars aligning risk of these out and out optionality plays. The counter to that is these kind of huge pounds in the ground plays tend to have charismatic management teams that build a cult following around the stock. For example, there's no way I personally have the balls to short NOVAGOLD, just because I know it has that cult following. Kaplan's a very animated figure, and he talks about his company eloquently. There's a lot of people that like this company, including people inside Sprott. So, it's going to stay at valuations that make me scratch my head throughout the course of the bull market. I'm almost certain of that. So it just depends what you're doing, and investors just need to know what they're investing in. Are they investing in a company because they think it's going to be the world's next biggest gold mine and it's going to produce for 50 years and make them a bucket load of money over the course of their lifetime? Or are they speculating on higher gold prices and the ability of management to create a narrative around a story, and speculate on higher, basically it's almost the greater fool theory of someone buying your shares off you for a higher price. And a lot of people make a lot of money doing that. It's just not my personal investment philosophy. That's not how I invest. So I'm not an owner of NOVAGOLD. I wouldn't short it, but I wouldn't own it. It's just my personal opinion.
For those that are listening to us that are of the more trader orientation, not just the buy and hold resource investor, when you see the short report come out, is that a good time to short, at least for a week? Because so often it seems to work to where they're able to drive down these stocks, even stocks like I remember Northern Dynasty years ago that had a huge pump going into it, and then it was much of the deflation was a short report, I understand, prompting a lot of the sell-off, and just what we experienced recently here with NOVAGOLD. I mean, is that a good short-term short for some traders?
If you might be able to jump on the back of some momentum from a short report. In general, though, I'd advise most investors not to try and short stocks. You can really have your face ripped off if you get it wrong. I'm a professional investor. I do it every day, and I have tried my hand at shorting on numerous occasions, and I've usually got burned. It's very, very hard to get right. Most people, especially in a rising market like we're in right now, in the gold stocks at least, you've got to be very, very careful shorting, because obviously theoretically you're open to potentially infinite loss, rather than, going long, you can only lose what you put in. So in general, I have a big chat with clients that want to short stuff, trying to talk them out of it most of the time. The only time I'd ever really go to town on a short is if I thought something was a scam, an outright scam, or there's some sort of fraud involved. What I've learned through my years in investing is overvaluation usually leads to even greater overvaluation. Getting the timing right is very, very hard. But to answer your question, if you're going to jump on a short trade right after a prominent short trade, is probably not the worst time to do it, but I'd be very, very careful before you do that.
On the idea of shorting stocks, there's been discussion of the reinstatement of the uptick rule, which is a rule that would say you can only short these microcap miners, in our case, if they're going up. You can't continue to pummel them down. I had Rick Rule on the show. I asked him about that. Rick is not for the reinstatement. Other guests, mining CEOs, were for the reinstatement. Those are just some opinions that have been shared on this show. What would be your take?
I probably fall in the category of Rick, to be honest. Firstly, I don't think it's a huge problem, or at least not as big of a problem as many people think it is. In terms of penny stocks, if you try and borrow short against a penny stock, most of them you're not going to be able to find stock to borrow. Most brokers won't let you short penny stocks, or there won't be any shares available to short. Slightly, there are some bigger juniors that you can, because I've seen it done. As far as I'm concerned, if a company is a legitimate short, they deserve to be shorted. If they're not, and someone shorts it, and I like the company, it's an opportunity for me to buy, irrationally cheap shares. It's almost going to work in my favor. And if it's not a company I like, then there are bigger things that I worry about than the uptick rule and the complications that go with that. So to be honest, it's not a subject that I've given much thought to outside of just reading the headlines. I don't think it would affect me and what I do and what my clients do. And I do think it's probably one of those things, you read on all the forums, and you hear people talking about the manipulators, and I think it's an issue that's probably overstated. It's definitely, and I'm sure there are select cases that's been a major issue, but by and large, I think it's the short sellers manipulating prices is an overblown sort of, I don't want to call it a conspiracy theory, but you know what I mean, along that kind of vein.
Many American mining investors don't want to, or it's not easy for them, I should say, to purchase the stocks directly on the venture exchange in Toronto, so they buy on the OTC markets. And I've had discussions with investors and with mining executives about whether they should upgrade from the OTC-pinks to the more respectable OTCQB or QX, which costs the company some money, but there's a little higher requirements. As a broker, do you have any opinion or advice here?
Yeah, I get asked that a lot from company management teams. Actually, it depends. You really need to know your investor base. And if you do have a sizable US investor base or you're going to market yourself relatively aggressively in the US, then the cost probably justifies. The expense is probably justified. If you have a vastly Canadian or non-US investor base, how many companies do we see with an OTC listing that is basically illiquid and doesn't trade? So it really depends. If you're going to make a concerted effort to appeal and market to an American crowd, then it's definitely worth it. There are, obviously we here at Sprott, we can buy in the Canadian market, we can buy in the Australian markets. So it's not an issue for us. Like you said, there are a lot of investors that just have a discount broker that doesn't allow them to trade internationally. And if you are going to be roadshowing, speaking to American investors, then I have seen success with companies, bumping up to a QX or QB on the OTC. So it really depends.
What type of feedback have you been getting from your clients? I know that you're very responsive and communicating with numerous people throughout the day. Can you share anything in terms of sentiment or questions that you're getting?
You know what? I kind of feel like we're in a really sweet spot right now. My client, everyone's happy. Everyone's accounts are doing well, but there's nothing close to euphoria. I'm still getting people taking profits, waiting for the pullback. I even had a client move, almost entirely to cash today because they're worried about, a move to the downside. We're not having these times where, everyone wants in on everything. To me, it's a really nice sentiment. Is at a really nice juncture right now. I feel quite happy with where everything is. There's just enough interest that things are moving up. Financings are oversubscribed, but people are interested. Stocks are going up, after financings rather than getting obliterated on the announcement of a placement. But we're still not seeing, your taxi driver giving you mining stock tips. So right now, this is probably the sweetest spot in terms of, interest, but not euphoric sentiment that I can recall in my career. And I'm really excited with where the next sort of 6 to 12 months, the outlook for the next 6 to 12 months. It feels really good.
Sam, this is a question I've asked numerous guests since we saw that crash in March. And due to the unprecedented events that we've been seeing, both from the Fed and how governments have responded to the COVID crisis, NASDAQ hits an all-time high when U.S. unemployment is at multi-decade highs. It's just craziness. I mean, for your interpretive grid, when you look at all this and then you consequently advise your clients, has this been one of the more difficult times for you to accurately interpret what's going on and advise people?
Absolutely. I'd be lying to you if I said I nailed everything. I don't know anyone hand on heart that can say, middle of March, they sent out something to their clients or in their fund and just loaded fear. There was blood in the streets, but it lasted 2.5 weeks. It's the shortest bear market in history and fastest rebound in history. And I'm still a little bit nervous. I like the precious metal space because I think it's gonna, there'll be volatility events again, but it kind of, it's your insurance policy for in terms of the broader economy. Look, Billy, honest truth is I don't know anyone, whether they be investment advisors, fund managers, any investment professional, that can hand on heart say they picked the absolute bottom and loaded up max long, middle of March. The reality is it was an extremely scary time. I have never seen big multi-billion-dollar stocks that we follow moving, 15 to 20% in a session. It was crazy, and I'm still a little nervous that the end is not the end is not in. We could very well experience another episode like that. That is why I favor the precious metals, because I think, despite short-term volatility, they're going to be your insurance policy. They should be your insurance policy over the mid to long run through all of this. But yeah, it's definitely been a very, very tough time to be a manager or investment advisor. But at the end of the day, you have to make decisions amongst uncertainty. And if everything was obvious, we'd all be millionaires, right? You'd make the obvious decision and it would pan out. So this is what we are here for, to help our clients. And volatility is the friend of the long-term patient investor. So, I am advising clients hold a little bit of cash. I sent out a write-up a few weeks back saying, hey, we've had a really good rebound. It might be worth having 5-10% of your portfolio in cash. Cash is optionality. Should we have another volatility event, so you've got some dry powder on the sidelines to take advantage of that. Obviously, on days like today, when the Fed announces another couple of years basically of zero interest rates and gold stocks rally, your clients kick you and say, oh, you're an idiot for why aren't I max long? But if you train them and you're aware of how markets work, cash is a really powerful thing. And so, how you manage that through times like these is really, really important. And I do think having a little bit of cash, I think you want to be fairly long, particularly in the precious metal space right now. But having a bit of cash is really, really key in times like these. And
you would still be bullish on the base metals per our previous discussions?
You know what? Look at old Dr. Copper at the moment. They obviously, that surprised a lot of people. And what we're hearing, both directly and anecdotally, is that the copper market continues to be extremely tight. We're seeing huge demand come back online in China, and we're still having supply disruptions, particularly in South America. So there is a bit of a short squeeze type of scenario going on in the copper space at the moment. Whether that will last or not, is anyone's guess. But the sheer amount of money they are pumping into this global economy, we're going to see some really strange things. I mean, it's hard to be max bullish towards things like base metals in amongst the COVID situation, right? With, logic would tell you that global demand is going to fall off a cliff or has fallen off a cliff, which it largely has. But you have had massive supply disruptions too, and you've got just about every government in the world hell-bent on stimulating their economies, to nirvana over the coming years. So you're going to see all sorts of fiscal programs, and a large percentage of that is going to go into infrastructure spending, materials, intensive stimulus programs. So you know what? I would not want to have zero base metal exposure in my portfolio either. I've personally upped my exposure to the really highest quality base metal producers over the last, that was one of the biggest things I did during March, actually, was bought a new material position in my personal account.
If you're a high net worth resource investor and you're looking to put, I would say, at least 6 figures into the resource sector, and you're seeking professional guidance from somebody who understands, as I said in my introduction, the financial side of the business, but also understands how to interpret geological numbers, having been a formerly trained geologist himself, I would encourage you to reach out to Sam. I'm going to put Sam's email address in the show notes so you can email Sam. And if you're calling or emailing him as a result of the show, please do let him know that as well. Sam, as always, I appreciate your 6-month check-in on Mining Stock Education. Thanks for educating my listeners today.
Thanks for having me on.